Today, we're going to challenge a number that pretty much everyone trusts to make big decisions, the average. But what if that number isn't telling you the whole story? What if, and this is the key, what if relying on it could actually lead you straight to ruin? We're about to pull back the curtain on the hidden danger of the average.
This quote right here gets to the heart of it. It's a pretty bold claim, right? It goes against so much of what we're taught. It says that focusing on the average, well, it's a trap. So if the average isn't the right thing to trust, what is?
To really see why the average can be so deceptive, let's imagine a scenario. We're going to look at two different trading strategies. We'll just call them strategy A and strategy B. Now, on the surface, they share one really important number that makes them look like they're equally good.
All right, let's break these down. Strategy A is what you might call a steady grinder. It wins about 55% of the time, and its wins and losses are basically the same size. Let's just call that size 1R for 1 unit of risk. Pretty straightforward. Now look at strategy B. Whoa, that 81% win rate looks incredible, right? And each win is twice the size of its risk, so plus 2R. But, and this is a huge but, look at the loss. A single loss is a massive minus 8R. It literally wipes out 4 wins in one go.
So, how do these two totally different ways of winning and losing actually stack up over time? Well, if you do the math, it's a calculation called expected value. You find something kind of shocking. After you factor in how often you win, how often you lose, and how big those wins and losses are, both strategies have the exact same average return per trade, a positive 0.10R.
And right here, this is the trap. This is where everyone gets fooled. If you only looked at this one number, this average return, you just shrug and say, well, they're equally good, it doesn't matter which one I pick. But would you really be indifferent?
So, I'm going to ask you directly. Knowing only that they make the same average profit in the long run, which one are you picking? Are you going for the steady grinder or the machine with that super high win rate? Really think about it for a second, because your gut feeling right now, it reveals everything.
That choice, that's where we uncover the hidden danger. Because here's the thing, you don't experience an average. You experience a journey. You experience a path. And the paths these two strategies take you on, they are worlds apart.
This is such a critical point. You never feel the average. Averages are just abstract math, a summary that exists on paper. What you actually live through, trade by trade, day by day, is the real sequence of wins and losses. And that sequence, that's the path.
So, to put a fine point on it, the path is the thing that determines if you even get to stay in the game long enough for that nice positive average to ever show up. If the path takes a dive so deep that it wipes out your account, well, that long-term average becomes completely and totally irrelevant, doesn't it? Let's think of it with an analogy. Strategy A is like running a solid, maybe kind of boring business. You've got good months, you've got bad months, but the losses are always manageable. You can handle the rough patches because no single bad day can sink the whole company. It's a steady, predictable climb over time. Now, strategy B is a completely different animal. It feels incredible for a while. You're just racking up these wins, feeling like a genius, feeling invincible, but hidden underneath that amazing win rate is a ticking time bomb. An event that you know is rare, but it's guaranteed to be devastating when it finally happens. Let's actually walk through what the path of strategy B feels like. You start trading. First trade, boom, a nice 2R win. Your account's up, you're feeling good.
Next trade, it happens again. Another 2R win. This feels amazing. That 81% win rate feels like a sure thing. Your account balance is just climbing and climbing. I mean, what could possibly go wrong?
And then this happens. The time bomb goes off. One single catastrophic negative 8R loss. It doesn't just wipe out your last 2 wins, it erases your last 4 wins and throws you deep into a hole. It's a huge psychological gut punch and a massive financial blow. The long-term average didn't change, but your path just took a nosedive off a cliff.
Okay, so that feeling, that shock you just saw on the screen, we can actually measure that. We can move past analogies and look at the cold, hard data. This is all about what happens on the bad days and, more importantly, whether you can survive them.
So to test this, the source material talks about running what's called a Monte Carlo simulation. Just think of it like a super powerful computer playing out thousands of possible futures for each strategy. And it's a totally fair fight. They start with the same money, they risk the same amount on each trade. The only thing that's different is the strategy's unique path of wins and losses.
And the results are, well, they're not even close. The simulation shows that an account trading strategy B has a dramatically, massively higher chance of going to zero, of blowing up, than strategy A. And let's not forget, these two have the exact same positive average return. This one chart just makes that hidden risk totally impossible to ignore.
And that right there is the big secret. This is what professionals and serious risk managers understand in their bones. They obsess over the path, over the shape of the wins and losses, because they know that their number one job, above all else, is survival. A fantastic average is completely useless if you don't survive the path to get there.
So let's bring this all together and really nail down the core lesson here. It's all about shifting your focus away from a single, seductive number and onto the entire journey. Here's your new playbook, a simple 3-step framework. First, from now on, always question the average. Ask yourself, what could this number be hiding? Second, analyze the path. Look at the actual sequence of outcomes. How bad are the bad times? How deep are those drawdowns? And third, always, and I mean always, prioritize survival. A strategy that keeps you in the game is infinitely more valuable than one with a great average that could knock you out on any given day.
And that brings us to the final question, the one I want you to take with you. When you look at your own strategies, in trading, in your business, even in life, are you letting yourself get seduced by a promising average? Or are you truly, honestly prepared for the path you'll have to walk to see it through?